I keep getting this question, why don't you just buy the S&P 500 instead of a world ETF like the FTSE All World or MSCI World? After all, the S&P 500 has some of the lowest fees at only 0.03% per year and keeps outperforming global ETFs. Is diversification really worth it if it hasn't yielded better returns lately? I totally get the argument, but it's sadly not that easy. Let's take a closer look into the pros and cons of either approach, compare the returns based on historical data, and end with what I've decided to do with the ETF investment portfolio I share with my wife, which has grown significantly over the past 7+ years. Okay, let's start by comparing the three indices so that we know what we're actually investing in. The S&P 500 covers the 500 largest publicly listed companies in the US and was launched by Standard & Poor's in 1957. The MSCI World covers around 1,400 large and mid-cap stocks from 23 developed countries and aims to capture around 85% of the investable market cap in each country. It was launched in 1969 by Morgan Stanley Capital International. And lastly, we have the FTSE All World Index, which contains around 4,200 stocks as it stands and covers a total of 49 countries, not only from developed but also emerging markets like India. It's by far the broadest and most diversified of the three and the closest representation of an actual world ETF. The index aims to capture around 90% of the investable market cap in each country, so an extra 5% compared to MSCI, including some that MSCI would classify as small cap stocks. It was launched in the year 2000 by FTSE Russell, with FTSE standing for Financial Times Stock Exchange. All three indices are market cap weighted. As a result of their strong performance over the past few years, US stocks currently make up around 70% of the MSCI World and 62% of the FTSE All World, meaning that whichever one you end up picking in the end, you'll end up with plenty of exposure to US companies. By the way, you can find links to the best local brokers in Europe for ETFs down in the description below, which is a great way to support me if you'd like to. I'm also going to put any ETF I mention, including its ticker symbol, down there as well. Now let's compare the returns over the longest possible time frame, starting with the last 32 years, where I'm going to use data for the MSCI All Country World instead of the FTSE All World for the first comparison, since it's easier to access and goes back further in time. Luckily, the return difference between the two tends to be minimal over the long run. So, which of the three indexes performed the best over the last 32 years, so from February 1992 until September 2024? Well, the MSCI World returned 8.53% per year, the All Country World an even more impressive 8.8% per year, but the S&P 500 ended up beating both of them with a compound annual growth rate of 10.98%. Since US stocks, especially from the tech sector, have grown exponentially over the past decade or more, this shouldn't be too much of a surprise. In fact, most of this outperformance seems to have occurred after the great financial crisis. Now, did the S&P 500 always have better returns over this period? No, of course not. Looking at the returns on a year-by-year basis from 1993 to 2023, the MSCI World outperformed the S&P 500 11 times, while the All Country World managed to outperform the S&P 500 index a total of 13 times. We even had a 6-year period from 2002 to 2007 where the two world indices did better than the S&P 500 every single year. That being said, US stocks still had better returns on average over even longer time periods, meaning going all the way back to the year 1900, while a global index would have yielded 5% per year after inflation over the past 122 years, US stocks compounded by an inflation-adjusted 6.38% per year. There were long periods of time where this wasn't the case though, which I'll show you in detail using another interesting graph later on in the video. This brings me to the pros of picking an S&P 500 instead of a world ETF. And since it's not all rainbows and unicorns, we'll of course also look at some of the cons afterwards. First, the fees for S&P 500 ETFs are significantly lower, going all the way down to 0.03% per year with the SPDR S&P 500. In comparison, the cheapest MSCI World, All Country World and FTSE All World ETFs have total expense ratios of 0.12 to 0.15% per year. Second, as we just discussed in the previous chapter, US stocks historically outperformed an MSCI World on average when looking at the last 100+ years. Will history repeat itself in the future? There's no way to know. Even still, I totally understand when someone mentions this as a reason for why they stick to the S&P 500. Now let's get to the cons of only investing in the S&P. The fact that US stocks, especially mega-cap tech companies like Apple, Nvidia, Microsoft, Alphabet and Amazon have so clearly outperformed over the past decade could mean that we may now see a period of underperformance compared to the rest of the world. To prove this point, did you know there have been plenty of prolonged periods in the past, I'm talking periods of up to 40 years, where you would have been better off holding an MSCI World ETF instead? I'm pretty sure the following two graphs will blow your mind. Here we can see the US stock market compared to the MSCI World. A number of 1 means they performed exactly the same. When it's above 1, it means the US performed better, and when it's below 1, it means the MSCI World performed better. As you can see, since 1970, there were plenty of periods of time where the MSCI World performed significantly better than the US stock market. In fact, at one point in 1989, the US stock market only had 52% of the performance of an MSCI World after a 19-year period. Here we can even see a period as long as 41 years, from 1970 until 2011, where US stocks underperformed the MSCI World. It wasn't until December 2011 when the US stock market started gaining momentum and started outperforming significantly. Here's another perspective. The MSCI World was pretty much in the lead for a very long period of time, and at one point almost had doubled the total performance compared to the MSCI USA. What followed was a neck-and-neck race, with the two changing depending on the period of time you look at, and it wasn't until November-December 2011 when the US stock market started taking off compared to the MSCI World. The thing is, we all suffer from recency bias, which means we tend to value recent information, like higher US returns throughout the last decade, more compared to previous periods of time. This is likely why a lot of investors have been thinking of going all in into an S&P 500 ETF, completely forgetting that it could also end up underperforming a global ETF for decades, which we've already seen happen in the past. Con number 2 ties in with what I just said. There's no way to successfully predict the future and to know if the most profitable, innovative companies will still be based in the US in a few years, a decade or more, or if they'll be located in other countries, including promising emerging markets like India, for example. Also keep in mind that due to their volatility, ETFs are long-term investments. You should have a time horizon of at least 5 years, ideally 10 years or more. Do you really want to risk asking yourself in the future if you made the right decision by focusing on a single country's stock market? It's likely you'll start to have doubts about your strategy as soon as you see other regions like Europe, Japan, or emerging markets outperform for a few years. You could easily avoid this by just buying the entire world of stocks, either covering all developed markets, or what I find even better, include emerging markets as well as extra insurance. Yes, you'll be paying slightly higher fees, but you'll be holding thousands of stocks across different regions and currencies, significantly diversifying your investment compared to an ETF that's only made up of the top 500 US stocks. Now let's get to my own ETF investment strategy. I like to keep things as simple as possible by just buying a single ETF, the Invesco FTSE All World, which covers thousands of stocks from the entire world, including emerging markets. Whenever I make investment decisions in the stock market, I make sure I only pick ETFs I will be willing to hold forever, which means that they need to be in line with my long-term investment strategy. That way I'm never forced to sell older ETF shares I hold, realizing taxable profits before I actually need the money, for example later on in retirement. I have no issues moving my monthly savings into a less expensive ETF accomplishing the same though, which is exactly why I moved from Vanguard to Invesco a couple of months ago. But my wife and I didn't touch our existing Vanguard FTSE All World shares that are nicely in profit, just like we kept all our xTrackers MSCI World shares from many years ago. Before we get to my personal conclusion, let's quickly take a look at the best ETFs for each strategy. You can find them using my two favorite low-cost brokers in Europe, Interactive Brokers and Trade Republic, both of which are linked down below in case you'd like to support me. I'll also put all of the ETF names and ticker symbols there. With a fee of only 0.03%, in my opinion the SPYDR S&P 500 ETF is currently the best one covering the US stock market. As for world ETFs covering only developed markets, my two personal favorites are the SPYDR MSCI World and the slightly broader Vanguard FTSE Developed World ETF, both of which come with 0.12% in fees per year. Meanwhile, if you want to invest as broadly as possible and include emerging markets as well, all via a single ETF, which is my preferred way to invest, I would look at the Invesco FTSE All World with a 0.15% fee, the SPYDR All Country World, which recently lowered its fee to 0.12%, and the even broader SPYDR MSCI All Country World Investable Market ETF with a total expense ratio of 0.17% per year. In case you're wondering why I didn't include Amundi's Prime ETFs in this list, make sure you check out this recent video of mine afterwards. Alright, let's get to the conclusion. Is it better to buy an S&P 500 or a world ETF? At the end of the day, the decision is yours. After all, it's your hard-earned money and you need to have full confidence in whatever ETF you're holding in the long run. Personally, I wouldn't feel comfortable betting everything on just US stocks via an S&P 500 ETF, as dominant as they may be right now. That's because the future remains uncertain and there's just no way to know if the most profitable, most innovative companies will still be US based in the coming years and decades. And even though the US market has outperformed over the past 10 plus years, this wasn't always the case. In fact, as I've shown you today, there have been 40 plus year periods when MSCI World would have performed better. Not only that, with a high current market share of 70% in an MSCI World and 62% in a FTSE All World, you'll still profit if US stocks keep outperforming, but you'll also have some insurance in case the opposite happens and other countries become more dominant in the coming years and decades. That's why my wife and I are continuing with a single ETF covering the entire world, as we'd like to avoid ever questioning if we made the right decision by focusing on stocks from a single country, and we like to keep things as simple as possible, letting the market decide how much is allocated to each region on an ongoing basis. But that's just my personal preference. I promise I won't judge if you decide to do things differently. You need to go with whatever strategy you're most likely to stick to over the long run and which makes you sleep best at night. By the way, if you're currently holding an S&P 500 ETF and you'd like to add stocks from other developed countries, the xTrackers MSCI World X USA is a great option to do that. Now I'd love to know your own preference. Are you investing in an S&P 500, a World ETF, or something else entirely? Let me know in the comments. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. You can find the links to the best low-cost brokers in Europe for ETFs down below in the description, which is a great way to support me if you'd like to. Thank you guys so much for watching, have a wonderful day, and until next time.